Welcome to The Explainer. Today, we're diving straight into the student loan debt bubble. And honestly, what happens next? Okay, let's dive right into this because it's a fascinating and frankly super urgent financial mystery. How exactly are these massive global macroeconomic forces secretly pulling the strings of your personal finances? Well, it all starts with this staggering number, $1.838 trillion. I want you to just keep this figure in your head for a second because it represents an absolutely massive, overwhelming burden weighing down the American consumer right now. I know, a number that big is kind of abstract, right? But the effects are literally being felt at kitchen tables across the country today. And to truly wrap our heads around what this number means and why it's threatening the broader economy, we actually have to zoom out and look at the whole shebang first. And that brings us to the big question. How did global power shifts and central bank policies basically create the ultimate trap for the everyday borrower? Because to decode this micro-level debt squeeze that millions of graduates are feeling, we have to look at the global macroeconomy. The tectonic plates of global finance are shifting right beneath our feet. And you know what? That shift dictates everything from national interest rates to the cost of your groceries. So, let's start with the US dollar. For decades, the dollar has enjoyed this totally unchallenged position as the world's primary reserve currency. It basically gave the United States the exorbitant privilege of easily financing deficits and keeping our domestic borrowing costs relatively low. But that dominance is quietly slipping. Today, the US dollar share of foreign exchange reserves has dropped to exactly 57.74%. And this erosion is being driven by geopolitical fractures and deliberate moves by global central banks to kind of diversify their holdings away from relying so heavily on the dollar. Now, what's really interesting about this is where all that diversified wealth is actually going. Global official gold holdings have just surged to nearly $4 trillion, $3.909 trillion to be exact. Central banks around the world, especially in emerging economies, have aggressively accelerated their gold purchases. They're basically seeking safe haven assets and a geopolitical buffer, which is physically reshaping the entire balance of global monetary power. And when we compare those two forces side by side, we're looking at a historic turning point. For the first time in modern monetary history, global central bank gold holdings at $3.909 trillion are virtually at parity with foreign official holdings of U.S. government debt, which sit at $3.920 trillion. So gold and treasuries are essentially tied in central bank portfolios right now. This de-dollarization trend forces the United States into navigating a much tighter, way less forgiving global financial landscape. Which brings us right down to the national level, specifically the Federal Reserve. For years after the 2008 crisis, the Fed used quantitative easing, basically injecting money and lowering yields to make borrowing cheap and stimulate growth. But in response to post-pandemic inflation and those shifting global dynamics we were just talking about, the Fed aggressively pivoted to quantitative tightening. They are actively removing money from the system, raising rates, and heavily restricting borrowing to cool down the economy. It is a complete 180 from the economic landscape we all kind of grew accustomed to. And that leads us to the reality of mid-2026. The Fed is maintaining a higher-for-longer policy, holding the benchmark federal funds rate steady at 3.5 to 3.75%. Despite earlier market hopes for aggressive rate cuts, the persistent stickiness of inflation means those cuts have been pushed way out. In fact, major institutions like Goldman Sachs don't expect any real relief until 2027. The era of cheap money is officially in the rearview mirror, guys, and everyday borrowers are the ones about to foot the bill. So we've gone from shifting global currency reserves to historic gold hoarding to the Federal Reserve clamping down on the money supply. But let's bring this home. What does this global tightening actually mean for you? How does a massive macroeconomic pivot trickle down from Wall Street all the way to Main Street? And this brilliantly illustrates the immediate fallout for the everyday consumer, which is incredibly stark. The Fed's policy rate dictates borrowing costs across the board. Right now, we're seeing average credit card APRs soaring past 20%, while mortgage rates hover painfully near 7%. It's created an incredibly expensive, almost hostile borrowing environment for everyday people who are just trying to finance major purchases or honestly just keep up with the cost of living. Which brings us right back to our massive number from the beginning, $1.838 trillion. In a world of high interest rates and expensive borrowing, this number represents the total U.S. student loan debt bubble. It is the second largest category of household debt in the entire country, eclipsed only by mortgages. But here's the catch. Unlike a mortgage, this debt isn't tied to an appreciating physical asset. It's literally an anchor weighing down an entire generation of consumers, right as the global economy tightens the screws.
So the crucial point is the sheer suffocating scale of this crisis. Let's just look at the math. We're talking about 42.3 million federal borrowers. The average individual debt sits at $39,633. And perhaps the most sobering statistic of all, it takes an average of 18.5 years for a borrower to fully pay off these loans. That is nearly 2 decades of a person's prime economic life, where a huge chunk of their income is instantly siphoned away to service debt rather than being invested or actually spent in the economy.
And the margins for these borrowers are incredibly tight. Look at this. The average starting salary for a bachelor's degree holder is $65,677, but they are stepping into the workforce with nearly $40,000 in federal student debt. When you factor in taxes, rent, food, and the fact that borrowing costs on things like auto loans and credit cards are at multi-year highs, these borrowers are left with virtually zero expendable income. They are tapped out before they even begin.
Let's move along and see how this builds, because this intense financial pressure doesn't just hurt the individual, it triggers a really dangerous economic chain reaction. Step 1, we have those high Fed rates colliding with massive student debt. Step 2, this immediately causes delayed homeownership as buyers are completely priced out. Step 3, it stunts small business creation because heavily indebted graduates just can't get startup capital. And finally, step 4, the whole thing culminates in slower overall economic growth. It's basically a perfect storm of macroeconomic tightening squeezing a microeconomic debt bubble.
Let's break down those dominoes, starting with housing. The data here is crystal clear. Homeownership declines by 1.8% for every single $1,000 of student debt a graduate holds. Right now, 51% of renting borrowers say they're actively delaying buying a house because of their loans. And when you combine that debt load with 7% mortgage rates, nearly a quarter of millennial renters have simply given up. They report that they never expect to own a home. That removes a massive, massive engine of wealth creation from the economy. Next, we look at the very lifeblood of the American economy, small businesses. If a borrower has more than $30,000 in student debt, they're 11% less likely to start a new business. Furthermore, a mere 3.3% increase in local student loan debt correlates with a 14.4% decline in new business creation at the county level. Heavily indebted graduates simply can't take the risk of entrepreneurship, and they definitely can't secure business loans in a high interest rate environment. The innovation engine is stalling out.
And then, of course, there's everyday consumer spending. Economists note that for every 1 percentage point increase in a consumer's student debt-to-income ratio, their overall consumption drops by 3.7 percentage points. Currently, 18% of student loan holders report that they struggle to buy even basic daily necessities because of their loan obligations. If millions of consumers spend almost 2 decades paying off education debt, their ability to actually participate in the broader economy just plummets. Which leads us to a highly surprising and honestly troubling reality. When household debts and living expenses exceed a consumer's income, they have to rely on social safety nets just to survive. Today, SNAP recipients, the program formerly known as food stamps, include over 4.6 million college graduates. Millions of people did exactly what society told them to do. Get a degree, secure a better future. But the math of the debt in a high-rate environment has pushed them into a severe financial squeeze.
So what happens when you combine stunted housing, failing business creation, and depressed consumer spending? It bubbles right back up to the macro level. Total student debt has now grown to represent 7.04% of all Americans' personal income. Between 2010 and 2020, student debt grew at a significantly faster rate than personal income itself. This massive debt overhang is acting like a lead weight, actively dragging down the nation's long-term gross domestic product.
We began this explainer looking at the global stage, shifting reserve currencies, central banks fighting inflation, but ultimately it all lands squarely on the shoulders of the consumer. And that leaves us with a critical, provocative question. Can the American economy, which is fundamentally driven by consumer spending, actually survive long-term when its consumers are trapped beneath $1.8 trillion in historic debt? Right as global forces ensure borrowing costs stay higher for longer, it's a really fragile equation, and the way it balances out is going to define the next decade of our financial lives. Thanks so much for exploring this complex issue with me today.